Have you ever stopped to consider why the deeply technical and often quiet world of U.S. Treasury bonds is now signaling a major crisis unfolding in Washington?
It's a critical question. The scale of this is, frankly, hard to grasp. Since 2000, U.S. debt has been climbing about 8% a year, every single year.
Which is a compounding rate that many analysts are now saying makes the debt basically unpayable.
Exactly. But the immediate threat, the thing that's making this acute right now, is the interest. Those payments are already well over $1 trillion a year.
And
A climbing.
$6 trillion just in interest.
And that environment is forcing the U.S. Treasury toward a really dangerous outcome, potentially just printing money to fund the government.
Yeah.
It's all being driven by a rapid, persistent decline in demand for U.S. bonds.
Okay, so let's unpack that. That is an alarming setup. The mission for us today is to really get into why these global and domestic pressures have destabilized the bond market.
And then we have to look at this desperate plan, this Hail Mary pass being floated by Treasury officials to find a whole new class of buyers.
So where do we start? The collapse in demand.
Yes. If we look at the core issue, foreign interest in U.S. bonds is, well, it's under siege. There are really two huge drivers for this. One is geopolitical, the other is purely economic.
Let's start with the geopolitical one. What's driving major buyers away?
It's the fear of, for lack of a better term, dollar weaponization. Key countries, the BRICS bloc, they're increasingly worried about asset confiscation.
They saw what happened with frozen assets in other geopolitical disputes.
Precisely. They're looking at their own dollar reserves and thinking, are these really safe? They see U.S. Treasuries as potentially vulnerable to being seized or restricted.
So they're looking for alternatives to protect their own sovereignty. What about the purely economic fear you mentioned?
That's just a straightforward worry about debasement. Central banks see the U.S. government issuing mountains of new debt, running huge deficits, and they worry the currency itself is just losing value.
Right. It's simple supply and demand. If you flood the market with something, its value erodes.
It's not just about getting a bad return anymore. It's about the long-term decline in the dollar's reliability as a store of value.
And this shift in who holds the debt is so critical to understanding the instability. I mean, back in 2000, only about 60% of U.S. debt was held by global markets.
And today, it's closer to 80%.
So if that foreign exodus happens quickly, the whole U.S. economy could destabilize fast.
And what's fascinating here is the total reliance on the open market. We're talking about individuals, companies, foreign governments. Washington has no control over who decides to head for the exits.
And it's not like the government is helping itself by being fiscally responsible. Washington keeps flooding the market with more debt.
They're funding those strategic policies, especially this tariff and industrial waves with China. They are borrowing enormous sums of money just to buy raw materials.
Things like steel, copper, all the inputs needed for new chip plants and data centers.
Exactly. And the spending is creating an immediate, and I mean painful, boomerang effect right here at home. The tariffs designed to protect U.S. industries are causing input costs to just shoot up.
I saw the numbers on aluminum. Prices are hitting nearly $5,000 a ton.
Higher than the peak of the pandemic shortages. So the cost of these domestic ambitions is skyrocketing, which means the debt issuance to pay for it all is, it's not going to stop.
And this is where it gets really interesting, where you see the bind the Treasury is in. They're trapped. The normal, responsible way to borrow issuing long-term 10 or 30-year bonds is basically off the table.
It's just not viable. Why? Because issuing a flood of long-term debt right now would push the benchmark 10-year Treasury yield way above 4%.
And that matters because
That would doom every single borrowing rate in the country. Mortgages, car loans, corporate debt. It would trigger a massive wave of bankruptcies, mass layoffs. It would collapse the economy.
So they can't afford to tell the market the long-term truth without causing an immediate crash. Which raises the question, if they can't issue long-term bonds, what's the alternative?
They're forced entirely into the short-term market. They're issuing incredible amounts of very short-duration Treasury bills or T-bills.
These T-bills now make up, what, over 20% of the entire debt market.
And that share is growing fast. This is the issuance trap. A 10-year bond, you defer the crisis for a decade. A 30-day T-bill, you have to refinance it constantly. It's like running up a down escalator.
The pace is just unreal. The Treasury is now issuing nearly $600 billion in T-bills in a single week.
Think about that. Every month, they have to find buyers for that amount all over again, just to roll over the existing debt, not to pay it down, just to keep the lights on.
So the crisis shifts. It's not just about the interest rate anymore.
No, it becomes about the sheer availability of funding. That $600 billion weekly figure is expected to grow to $1 trillion, maybe even $2 trillion. Who is going to be there week after week to buy that much debt? The traditional buyers can't absorb that scale forever.
So a collapse in foreign demand meets a spending addiction, forcing the Treasury into this unsustainable T-bill trap.
Okay.
Okay, before we get to the wild final gambit, what's the official story? What's the hope?
The official hope, the public line, is that U.S. economic growth is going to just explode by 2026, driven by these industrial policies, that the U.S. will just outgrow the debt.
A big if, given that current data shows rising costs and falling exports.
A very big if, which is why if that boom doesn't happen, the Treasury has to fall back on its final desperate idea, using stablecoins to save the Treasury market.
Let's get specific. What kind of stablecoins are we talking about here? This isn't Bitcoin.
No, not at all. The proposal is focused on a specific type of cryptocurrency designed to hold a steady value pegged to the US dollar, and crucially, it has to be backed by assets.
And the proposal is for that backing asset to be
US Treasuries. Specifically, the short-term T-bills we were just talking about, the issuers would have to hold T-bills to back their coins so they can meet redemptions.
This is the $3 trillion dream, then. The idea is to grow the stablecoin market tenfold, which would supposedly create this explosive new demand for U.S. bonds.
And in theory, it would also lock in dollar supremacy globally, making a digital dollar the go-to for transactions, especially in unbanked regions.
It's a beautiful narrative.
It is, but it collapses on itself pretty quickly. I mean, think about who the buyers are. Stablecoin users are not structural, dependable buyers like a central bank. They're risk-on money.
They're fickle. They're driven by crypto market cycles and volatility.
Exactly, which introduces a terrifying inverse risk. Imagine a major crypto market meltdown.
Liquidation. The stablecoin issuers would be forced to sell their T-bill reserves to get cash to meet redemptions.
And if that happens quickly, it causes short-term yields to spike, creating the exact opposite effect the Treasury wants. The U.S. Treasury market would suddenly become dependent on crypto cycles.
That sounds absolutely insane, tying the bedrock of the global financial system to one of the most volatile asset classes in the world.
It's an extraordinary suggestion. And even if it worked, the size doesn't add up. Let's be generous and say the market grows tenfold to $2.6 trillion.
That's still only enough to cover about 1 year's deficit. The black hole is just too big to fill.
And you still have the sanctions problem. The Treasury wants to target regions like BRICS, but stablecoins can still have their wallets frozen by the U.S. government. The geopolitical risk doesn't go away, it just gets digitized.
So the reality is, real structural demand is collapsing. We're already seeing gold reserves held globally exceed Treasury reserves. Stablecoins look like a digital Trojan horse at best.
So when you synthesize all this, the dream of using stablecoins is just beautiful, but incredibly fragile. It rests on too many optimistic assumptions, while the real, underlying structural demand for bonds is falling apart.
The dependency on short-term T-bills is the clearest signal you can get of an immediate funding crisis. And looking for salvation in a volatile crypto market just shows how few traditional options are left.
The crisis of availability of funding for those T-bills is becoming the central, immediate threat to the entire U.S. economy.
So what stands out to you? Consider just how reliant U.S. financial stability is becoming on a continuous, accelerating supply of short-term funding and the extreme fragility that dependency introduces to the entire global financial system.